Alright guys, this is Adam here, and I've been getting a lot of messages the last 2 days asking me to do a quick analysis about the market, what my thoughts on it, what should one do as an investor or as a trader. So let's take a quick look at what has happened. So unless you've been living under a rock, you know that in the last 2 days, the markets have been going through quite a big sell-off. Okay, so the last 2 days, the Dow Jones has dropped over 1,000 points in 2 days. That's really significant. S&P 500 has been down over 100 points in the last 2 days. So over here, if you can, let me just zoom in, you can see that, right, the market was on a very nice uptrend as so, and you can just see in 2 days, boom, yeah, these two big long red candles that took out about 100 points from the market in the S&P 500. So it's often said that the bulls climb up the stairs slowly. When the bear comes, they jump out the window, right? So the sell-off is really fast. And some people, ask, is there any way I could have predicted that this would happen? No one can predict the future. There's no way to predict when this happens until it happens. The question is, what do you do right now? So the first thing is, let's take a look at it in perspective in terms of the charts, the technical charts. So you can see that currently we have closed below the 200 moving average, which is this red line. And the 200 moving average is known as the last line of defense. It is the long-term moving average. So in general, when the stock is, or the ETF or the market is above the 200 moving average, we're on a long-term uptrend. When the price breaks below the 200 moving average and can't get back above in the next few days, and the 200 slopes down, that's a long-term downtrend or a new bear market. So questions people have would be, is this just another dip on the uptrend where it's a great buying opportunity so I can get in while the uptrend continues for the next few years, or is this the start of a bear market? So at this point of time, you can't tell yet, but it is critical that we look at the market in the next few days to again confirm, is it the start of a bear market or just a great buying opportunity on a new uptrend again? So let's put things in perspective. Let's kind of like zoom out to a wider time frame. So this is a 5-year chart of the S&P, and again you can see that during this bull market, every time we've got a big sell-off, what happens, right? The price goes down and it would, as you can see, bounce off the 200 moving averages. So bounce off the 200 moving average, bounce off the 200 moving average, 200. So you can see that multiple times this red line, the 200 moving average, has acted as the last line of defense, right? So every time it bounces off the 200 and you bought over here, boom, and you bought over here, boom, you bought over here, this would have been great buying opportunity. So again, the question is, the $1,000,000 question, is this going to bounce? And we don't know yet. We have to look at what happens today and next week, all right, the next couple of days to confirm. So we never predict the future. We can't predict the future. We are not fortune tellers. So we have to wait for confirmation. We have to wait for the market to confirm where it's going, and we follow the market. So if the market continues going up, we will go long, we're going to buy. If it breaks and keeps going down, it's a bear market. We have to exit our long positions as much as possible, and we can go short on the market and profit as the market goes down. Remember the statistics. Bear markets happen once every 8 to 10 years. Okay, so the last bear market was 10 years ago. I'm not surprised if it starts right now, although I don't think so because of strong fundamentals in the economy. So I don't think so, but you never know. All right. But even if it does go into a bear market, remember this: bear markets don't last. Bear markets last about 6 months to 1.5 years. And bear markets can be great buying opportunities as value momentum investors, because after every bear market, after every plunge, you've got the next bull market. It sets up for the next bull market, basically. And bear markets usually go down 20 to 50%. In a big bear market, like financial crisis, could go down 60%. I don't see it happening yet, but again, you never know. We never predict the future. We wait for the market to tell us what to do. So again, zooming in, let me just zoom in to where we are. Again, you can see the 200 is a strong support, and it's now below the 200. Now, many people would say, hey, it broke below the 200 and they panic and they start selling already, okay? Don't do that, right? So oftentimes people freak out when it closes below the 200. It's no big deal. As long as the 200 moving average keeps sloping up, it's not a confirmed downtrend yet. As long as the 50 moving average is not below the 150 moving average, it's not a downtrend yet. So not just yet, but we have to watch it closely. So I'm going to see what's going to happen today when the market opens. If the market opens today and is bullish and it can close back above the 200 moving average decisively, that's a really bullish sign. Time to go in and get aggressive going long. And of course, you can place your stop loss just below the 200 in case it breaks down again, you get out fast. But tonight, if it can't close back above the 200, and for the next few days, it can't get back above the 200 and it starts to slope down, then you got to be careful, right? You may want to trim your long positions and even start to go short on the market or specific stocks. Now, at this point of time, what do you do as an investor versus as a trader? Yeah. So as an investor, again, you're focusing on the fundamentals of good businesses. And these short-term corrections and even bear markets are great buying opportunities. So as an investor, what you can do is prepare your watch list of great companies and start to buy once you have got a bullish signal. But don't enter just yet. Don't catch a falling knife. Yeah. So some great companies now are beginning to look cheap. Like Facebook looks really cheap. Tencent from China looks really cheap. Apple is beginning to look not so expensive anymore. Amazon not so expensive anymore. So you may say, hey, now's a great time to start to buy at lower levels. Yeah, but not just yet, right? Because again, cheap can get cheaper, low can get lower. Always wait for confirmation for it to bounce with a bullish reversal pattern. So if you take a look at some individual stocks, let's take a look at Facebook, for example. Facebook is really undervalued right now. It's been selling off because of all kinds of bad news, the data scandal, the trade war, and now this. Okay. So if you take a look at Facebook, now by the way, in my long-term portfolio, I'm still long on Facebook for my long-term portfolio. I still think it's a great company. I'm still advertising on Facebook. So are many businesses. It's not going away. It will go higher eventually. All right. But for now, it's bearish in the short term. So you can see that Facebook has a strong support level at 149, which is where we are right now. So currently we're at a support level here. And again, if Facebook can bounce off this support over here, this could be a time to accumulate some good long-term positions, because I tend to buy long-term positions during support levels and during dips on uptrends. So I have to watch the level. If it breaks below this level, then do not add. It could go a lot lower in the short term. Remember, in the long run, fundamentals drive share prices. As long as the company is fundamentally good and strong, it's making money, prices go high in the long run. But in the short term, the stock market is irrational. It is illogical. In the short term, the market is purely emotional, right? So a good company that's worth $10 can be selling at $5, you bet. But by the same token, the market can be optimistically emotional as well. Something worth $5 can be selling at $10. So in the short term, it's all about emotions. So as an investor, you have to separate the emotions from the logic. Okay? So that's Facebook. If you take a look at Amazon, I love Amazon. It's a great company. I've always wanted to buy more, but it was really overvalued. And it's still overvalued, by the way, but right now a bit less overvalued. So again, if you zoom into the charts, you can see could be a buying opportunity coming up. You can see these are corrections in Amazon. And Amazon, again, has never really touched the 200 moving average. It is currently at the 150 moving average, the green line. So you can see previously the 150, let me just zoom in over here. You can see the 150 moving average, let me just zoom in over here, has acted as a pretty strong support for Amazon. Can you see that? Very strong support on the green line. So currently Amazon, tada, unsurprisingly is once again at the 150 moving average support. Although it did close a bit below that, right, a bit below that. So if we can see a bounce here of the 150, could be a great entry point for Amazon. Okay, so that's Facebook, that's Amazon, the FANG stocks basically, right? You have Apple. Apple's been doing pretty well, a bit overvalued right now, and Apple has now retraced to the 50 moving average. So you can see that all these stocks have retraced back to their key moving averages. If they can hold the moving average and bounce off, great buying opportunity, all right? But if it breaks below, don't get in yet. wait for the downtrend to end. You never know when. I'll keep you guys informed. All right. So in the US, we look at the FANG stocks: Facebook, Apple, Netflix, and Google, also known as Alphabet. I've mentioned this in my previous video. China is really cheap. It's really undervalued. It's ridiculous. But guess what? It's getting cheaper, right? So again, cheap can get cheaper. I'm looking at some great companies, but I'm not adding more yet because, I'm waiting for the downtrend to end for it to be a support level. But if you take a look at China again, let's look at the GXC. GXC is one of the China ETFs. It's been selling off like crazy because, again, of the trade war, the emotions. But in the long run, China will be the world's biggest economy, right? It just takes time. So we are, again, at a strong support and resistance level. You can see a very strong downtrend. So you never buy on a downtrend. We're waiting for a support. Let's see if the support holds. If it holds, we could start adding here. All right. If it breaks that, that's the next level of support for the China ETF, right? Looking at some of the great China companies, Tencent, I've mentioned this many times, the great company is undervalued, but my God, look at it. It's on a downtrend. So again, the lesson is, again, no matter how great the company is and how cheap, don't buy on a downtrend. Cheap gets cheaper, low gets low. Always wait for it to reverse to an uptrend. Wait for it to find support. Not yet there, right? I'm still waiting for this one, okay? How about Baidu? Baidu is the Google of China. Take a look at Baidu. Again, selling off like crazy, right? Broke below the support. It's again going down. Can't touch it yet. Waiting for a retracement. Let's see, we've got Tencent with Baidu. Alibaba, that's right, Alibaba. The BAT, we call it BAT. Alibaba, Tencent, and Baidu. That's right, Baidu, Alibaba, Tencent. BAT, right? So Alibaba, again, you can see resistance, support, broken support going down. So China's not looking good right now based on technicals emotionally, right? So you do not want to buy China yet. You don't want to add China yet. You're just waiting and waiting. Be patient. It will bottom eventually. And I keep telling people that the market only bottoms when there's panic selling, when there's blood on the street. So usually you want to see a 90-degree drop before the market can reverse its course. Okay, so waiting for that to happen. And when that happens, that's the time to get in. All right, like over here, check it out. Right, so this was a sharp sell-off, and then it started the new bull market. So remember, every bear market will end. We just have to be patient. If we do a bit of Fibonacci, let's remove some of our studies over here. Okay, and if we draw some Fibo levels, let's see what we get. I've not done this yet, by the way. I'm just doing this live in front of you. If we do this big A to B, here we go. All right. So A, B, C. And you can see this is 61.8%. This is a resistance. This 61.8% is a significant level. So in other words, right now for the Chinese ETF, we are approaching $85, which is a 61.8% Fibonacci level. So if you can hold there and bounce up, that would be a great time to start getting into China to ride the next bull wave up. All right. Okay, so let me summarize what I'm saying. I know I've been going on and on like a crazy person. Okay. Let me just load my studies back. Okay, so let me just summarize what I'm saying. So if you are a short-term trader, right? If a short-term trading portfolio, now's not the time to get long. You do not want to get long. For my short-term trading, I only go long when the price of the market is above the 20 exponential moving average, the 20 EMA, which is this red dotted line. So right now we are below the 20 EMA. We do not want to go long at all. Could we go short? Yes, possibly we can look for short setups while the market is on a short-term downtrend. But having said that, I will not go short just yet because the market's at a key moving average and it could bounce up and kill my short position. So if it breaks below the 200 and the 200 starts sloping down, I'll take more short trade setups in the short term. So that's for my short-term trading portfolio. Now for my long-term investment portfolio, it's a dollar cost averaging method, which means I select really good companies, I'm holding them in my portfolio like Warren Buffett, and I'm adding onto them every few months. And this sell-off is a great buying opportunity for me to add more to my great companies. But again, not just yet. Wait for confirmation. Don't catch while it's a falling knife. It could go a lot lower. So if it can close back above the 200 today and start bouncing back, I'll start adding to my long-term positions. Let me show you something else that's pretty interesting. This is called a heat map. This shows you all the stocks in the market. Now, the redder it is, the more it drops. All right, so red is down, green is up. Now you can see this was the 11 October sell-off, which was the first big sell-off here. All right, so this was 11 of October. And during this sell-off, take a look. Every single stock was red. Everything went down. Okay, so it's a massive sell-off, so panic selling, right? But here's the interesting thing. Yesterday, when we had the second... Now, on the other hand, yesterday, the sell-off that we got here, really interesting, because when I looked at the same heat map, I noticed that it looked like that. So this was the 12th of October, where, in other words, although the market went down, not every stock went down. We had pockets of green. Especially in the tech plays, and they weren't that red. So this tells me that yesterday's sell-off was actually slowing down and hitting the 200 moving average. So I highly suspect today, when the market opens on the 13th of October, we are going to see a bounce. But question is, will we bounce enough to close back above the 200 or not? So that's the question. Let's take a look and see what happens moving on. And I'll keep you guys updated. Hi, so if you like the video, you can subscribe for more videos by clicking the subscribe button. If you want to find out more about our live training courses in Asia, go to wealthacademyglobal.com. For online professional stock and forex trading courses, you can go to piranhaprofits.com. So this is Adam Khoo, and I'll see you soon.